Welcome to Money Matters TV. My name is Paul Mitchell. I'm your host for this show. I'm a commercial banker by background. Joining me today is my co-host, Michael Donahue, CPA with Drucker Scaccetti.
Very good.
Michael, welcome to the show again.
And
good
nice
to see you.
Yeah, good. Nice to see you again, too. Good.
So, family businesses is your specialty, I understand. Taxes and,
Yes,
and family businesses.
So we are a CPA firm, but we specialize, our niche is family health businesses and their owners. So a typical business in our client list, on our client list, would be a manufacturer, real estate, nursing home, any type of business that is family held and in need of like holistic tax services, not just tax returns. We don't lead with just tax returns.
And probably a little bit larger than a company family-owned business that I just walked by earlier today, John's Water Ice.
Yeah.
In South Philadelphia.
Yeah, nothing wrong with
since
John's.
1940, family-owned since 1945, the sign says.
I'm sure John's is doing very well, but our client base is usually a little bit more complicated.
Yeah.
And we see more and more of our clients doing business in multiple states, multiple countries.
Multiple countries even.
Yeah. So I mean, the world is getting flatter, I guess. So there's a lot of supply chain. So our clients might buy some of their materials from Asia, might actually sell into different markets in developed Europe. So I mean, so we see more and more of a global economy affecting even family businesses. Well,
let's talk about two aspects of family businesses. One is, are they still being formed? Or are they just, there's a whole bunch out there and that they succeed through generations and that type of thing. Some make it, some don't. Private equity buys a few. So there are less and less family businesses. I think that's a great question.
I never really thought of it that way. I think there's less now than there were before, but I would be curious to see what the statistics are on that. Only because, like you're saying, many have either consolidated, bought each other, and that's great. But most of them, that have succession issues are really dealing with it through a couple ways, but one of the big ways of dealing with it is private equity sales. So I'd have to think that the family health businesses that are out there compared to the top 20% of the family businesses that are out there today are probably larger than they were 10 years ago, and probably an accumulation of many other family businesses. And a lot of the exit strategies are through private equity. Because private equity is willing to pay more than the next family business down the road in a similar business or something like that. Well, I guess the alternative is with a family business, it's you look internally to your family and are the kids willing and able to take it? And that isn't always just a slam dunk. It's more and more complicated. And if you're the owner, if you own 90 or 100% or whatever, you'd like to have a few $1,000,000 to fund your retirement. Yeah. And maybe your kid is just going to continue to run the business and you're going to get $70,000 a year as a consultant. That's often and that's not really changing your lifestyle. That's right. That's a way. That's a great strategy if you have a kid that's capable to do it. And oftentimes, if that's not available, then you look to your management team. So these family health businesses are usually held together by a very good, long-standing management team. Where I live in South Jersey, there was recently a situation where a long-time family business for decades, about half a dozen locations. Okay, I won't even say the industry it's in, but it went out of business. It was kind of like a surprise. And 3 months later, a Midwest company in the same industry apparently has bought the assets. And I went there to see what was going on, and I met a guy at the desk. They're not really open for business yet, but they will be shortly. And I said, well, did you come from the Midwest? He said, no, I was with a former company. Yeah. I go, so what happened? He said, is there anything public you can say about it? I mean, I read about it in the newspapers and stuff. He said, well, no. And I'm thinking, times are good now. Yeah. And here's a family-owned business that's been around for a long time that went out of business. Right. So I'm guessing, Paul, you probably loaned a lot to these family health businesses. Oh, absolutely. Absolutely. It's probably the focus of our market, right. I focused on small, not very small businesses, but typically businesses with maybe $1 million in revenues up to 20, 30, maybe 40 million would be a large business for my particular market. Did you see that market change much from a lending standpoint? Or, I mean, more regulations came up over the years, obviously, but I guess that's good and bad. But did you see many changes in that relationship between family health businesses and banks? Well, I think the banks wanted to see the family-owned businesses be more professionally run. Okay, that is, typically entrepreneurs don't like to do financial statements. You're probably, they pay money for this thing, they do a tax return, you do tax returns, but why do they have to do another financial statement?
an annual financial statement,
Right.
monthly, quarterly, and give it to the bank.
To want to more professionally managed. Yeah.
But a bank
which has a
would-
cost to the family business.
Because of the recessions and that type of thing, banks said, well, we don't understand enough about the business.
Right.
So we need more professional management of the business. I mean, the owner is great, at sales and maybe, knows the operations, the technology, that type of thing.
Yeah.
But in terms of the financial end, not a great focus. And for a bank's viewpoint,
That's
mandatory.
risk. yeah.
Mandatory.
Right.
Make
right.
the investment. Some
Right.
of the best deals I made were with entrepreneurs that recognized that even though they didn't like to do that type of stuff, that they needed to do it in order to grow the business, to get
Right.
continue to get financing.
So to attract a lot of that professional management inside of family-held business, there's a lot of compensation issues that come up. So they oftentimes get a piece of the profits or a piece
Right.
of the stock even, but
Right.
at a minimum a piece of the profits going forward. So
Yeah.
you're motivating them. And
Absolutely,
even upon
sure.
exit, they would get a piece of the exit price.
Yeah.
So
yeah. That kind of professionalism, sure.
that kind of professional, you want them to be motivated because
Mm-hmm.
the family itself and that professional's interests are aligned,
Yeah.
to make the most profits and to be
Yeah.
the best.
And banks that would have the worst problems are those that didn't focus as much on that. That said, okay, we need to book loans. We'll book loans. It looks okay. I read about a failure to recently of a company that the owner was going to prison because he presented invoices. This was like a recruiting business. Invoices to a lender, commercial lender. They were fraudulent.
Sure.
Now, how could they be fraudulent? Doesn't the lender know? Then they check it out.
Well,
A good lender that knows what they're doing, they check it out. They call the person that owns the money. They double check the documentation. They're all over it.
yeah.
That's what you need to do in today's climate.
Yeah, I think that the business climate today for family-held businesses is strong. No, I do think that there's a strong. I mean, it depends on the industry, but there's a strong feel about their revenue growth and all. But in certain industries, it's becoming too capital based, where cost of capital is expensive, and if
Yeah.
you're competing for a nursing
Yeah.
as a nursing home, that cost of capital and cost of employing all these people
Yeah, yeah.
is really high, and bigger companies can actually.
So we talked about professionalism. In closing our remarks about this subject, I would say that the entrepreneurs, small business owners, family-owned businesses should really seek more professional help, advice.
Yeah.
Okay, to get some outside perspective, because they sometimes get too close to what they're doing, and they need that
Yeah,
perspective.
an objective look.
Exactly.
Yeah.
Michael, we have a question from one of our viewers today.
Oh.
Question is for Norman Williams of Philadelphia,
Okay.
and he asks, what are the two biggest tax mistakes in business, and how can they be avoided or corrected?
Yeah, that's a great question. So, I guess family businesses we're talking about, and Norman's question is,
Which is your field, yeah.
I gotta say, I don't think there's any two big mistakes. I think the biggest mistake with tax consulting in family businesses is there's not enough conversation between the tax consultant and the business owner. It's got to be a relationship. The best tax planning, the best financial planning is done in concert with the client.
On an ongoing basis,
Yeah,
not just once a year
not
or something
preparing
like
a
that.
return and handing it to them. We're checking in once a year and saying how's the business. But it's really understanding, their revenue stream, their customer base, their vendors that they use, what their real problems are. It could be with banks, and they need to be.
Yeah, sure.
But the most holistic way, and to realize that maybe management team's not working so well, so private equity will be more likely the exit. So you maybe how do you position yourself for a better exit price? Maybe by doing some smaller acquisitions in the middle. So a lot of things come from a stronger relationship with the family owner, with the family business owner. And so I can't say there's two big things like bad depreciation or bad accounting methods, but it's really that, because everything comes off of that relationship.
And not looking ahead enough. Because
Yeah.
if you are, for example, thinking about maybe selling your company to private equity, you just don't say, okay, private equity guy, here's my financial statement.
Yeah.
You got to plan a couple years ahead what they're thinking, what they're looking for, and how to present it
Yeah.
the best light.
Yeah.
Very good. Thank you.
Thank you.
So for our other viewers, if you'd like to send in a question to Money Matters, here's how you do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
And now I'd like to introduce our special guest for this show, John Mason, who's a bank consultant and financial economist. John, welcome to the show.
Thank you very much, Paul.
Could you explain, I sort of think I know what a bank consultant is, but what's a financial economist?
Well, that comes from the aspect of what I've done, in the sense that I've jumped from this to that and didn't have a linear path in my profession. So that basically the financial economist covers a lot of what I did and am doing, but is not real specific.
Okay. Well, I understand in order to be a real economist too, you've got to have a PhD, and you have a PhD.
And
so
I have a
that's-
PhD,
You're
yes.
qualified there in my book.
Thank you very much.
Yeah, so being a financial consultant, I mean, we're in this volatile time in the economy, but more and more people are talking about interest rates and the Federal Reserve and how the Federal Reserve is keeping rates down. And what is your feel? Is the Federal Reserve policy correct, or should it be changed?
Well, the Federal Reserve, the release just came out at 2 o'clock today, where they gave the results from the current meeting of the Federal Open Market Committee, and the Fed has decided to keep rates constant at where they are at the present time, which I don't think surprised many people, but I think that the explanation that they went through was detailed sufficiently in order to provide a justification for them keeping rates where they are now, rather than moving them up or moving them down.
What was that justification?
Well, basically, the economy's strong. Unemployment is at a 50-year low, something like that. I heard today too that just there was 255,000 new people employed just this past month again. So the statistics coming in from the labor market are very good. The economy came in at 3.2% year-over-year rate of growth in the first quarter of this year. So that's pretty strong. So we're getting a lot of strength there and the like, but you go on the other side of that, inflation is coming in under the Fed's target 2% rate of inflation. And as a matter of fact, that both of the primary indexes that they look at as far as prices are concerned, they dropped in April from March. So there's very little pressure seemingly coming from the price side, from the inflation side, and yet the economy stays very, very strong. And so as a consequence, there's not the pressure to raise rates because the economy, or to lower rates because the economy is staying strong, but there's also not the pressure to lower them because of the fact that inflation is not
A problem.
Or
perceived problem.
Why is it still not a problem if we had all this talk about tariffs and products that we're buying from other countries would cost more, and you and I would be paying more for them, and now the inflation's lower than ever? That's ridiculous.
Well, and Paul, it's not just a United States situation. I mean, you go to the European Union, and you find that the inflation over there is actually lower than it is in the United States. In Great Britain, the inflation is low, so we're experiencing very, very little pressure on prices throughout the developed world. So that is, that is a mystery to a lot of people, because if you remember, going through the whole recovery period, you had the Federal Reserve that was keeping interest rates low.
Yep.
Then it went through three
Increases.
periods of quantitative easing, where they increased the Fed's balance sheet up over $4.5 trillion. And if you want the figure about what it was before the Great Recession began, it was 925 million. So it went from 925 million to 4.5 billion or trillion. I'm sorry, it went from 925 billion
four
to
times,
4.5 trillion.
Real money.
Yeah.
And so never in American history have we seen an increase in the reserve base as took place during that time. And
How does that unravel, John? How do you unravel that kind of balance sheet?
Well, that's
$5
what they've
trillion.
That's what they've been trying to do over the last October of 2017. They started to try and reduce the balance sheet, and they had a very specific game plan in order to reduce. They started out reducing the balance sheet by $10 billion a month for the first 3 months, and then they moved it up to $20 billion the next 3 months.
So they're putting this money into the economy? Is that it? What's releasing?
Well,
it?
no, they are not. They were doing it by allowing securities to run off their balance sheet and then not replacing them.
Okay.
Okay, so they didn't want to have any open market activity, the Fed buying or selling securities during this time, because of what that might do, anything that might cause in terms of market disruptions. So they did it this way. They've done a terrific job in terms of going through this.
And has this had an impact on the U.S. dollar and the world markets also?
Well, we can get into that in a minute. It's,
Sorry.
I mean, I don't think it has done much at all in that respect. You could say they are tightening up, but as you look at the data, and my impression, and this is what I stand by, is the market is tremendously liquid. The commercial banks are tremendously liquid.
Big corporations.
This is what
lots of cash.
Big corporations, very, very liquid. This reduction of the balance sheet has been done in a way that I would argue has had next to no effect in terms of really the feeling about the liquidity that's in the marketplace. That, I think, is very, very good. I think that was intentional from the get-go as far as the Federal Reserve policy is concerned. Because even Bernanke, before he left, one of the basic things that he insisted that the Fed be concerned about is that it didn't err on the side of being too tight, that might cause disruptions in the banking system or the financial markets. That's what happened in 1937. Just a little bit of history there. There was lots of excess reserves in the banking system in 1937. In order to sweep those up, the Federal Reserve at that time raised reserve requirements, which overnight reduced excess reserves by a fairly substantial amount. What the Federal Reserve found out is that banks desired all those excess reserves at that time, so by raising the reserve requirements, they were in opposition to what the banks desired as far as excess reserves. What did the banks do then? They reduced borrowing, the money stock went down, and we went into the 1937-1938 depression.
Right.
Now, Bernanke, being a student of the Great Depression and the 1937-38 Depression, this is one of the things that he absolutely wanted to avoid in terms of this particular recovery. He did not want the Fed to err on the side of creating an illiquid situation. So the Fed has always tried to err on the side of monetary ease during this recovery, rather than being too tight.
John, do you see, though, that what are the big risks out there for the economy? Debt must be part of it at some point, right? If you can't unravel that.
Recovery's been going on for
over
a decade now.
Yeah.
So what are the big risks that you see to recovery?
Well, it's really hard to tell right now. And I think the concentration over the last 2 years now has been on the rest of the world. I mean, I think that people have gotten to the sense where they realize that we're in a global economy now, and that things that do happen overseas do reflect back on us. So you had the situation in Europe. Well, what happened over last year in Europe? Well, economic growth started backing off and got slower and slower. Inflation in Europe got slower and slower. On top of that, you got the Brexit situation in Europe, in Great Britain, in terms of what's going to happen to the relationship between Great Britain and the European Union and the like. So there was big concerns over the growth rate there. China slowed down. I mean, they say that they're still growing at 4 or 5% a year. We'd
so
take
bad.
that
Yeah, sure.
in a second. But for China, that was 2 or 3 or 4% under what they had been experiencing as far as the growth rate. So China had slowed down. Oil prices were increasing once again, and so affecting the supply chains and that kind of thing. So then that started to reflect back into the United States with the concern over the economic growth in the United States. And all that kind of build up into the fourth quarter of 2018. And that's when Jerome Powell, Fed chair, and the Federal Reserve Board backed off. I mean, they had originally signaled 3 interest rate increases for this year. In December, they backed off, or soon after that. And one of the reasons why was the concern over the growth that was being experienced in the world, and the fact that it seems to be decelerating. Well, okay, that was one reason. And the concern was that this was going to happen to the United States. I mean, what happened to government bonds? I mean, you saw government bonds hit a high of 3.25%, the 10-year hit 3.25% last year and the like. But what? I mean, I don't know if you saw it today, but it was closing, I think, under 250 today.
And those long-term bonds, aren't they frequently what residential mortgages are priced against?
That's correct.
Right.
That's correct.
When you talk about long-term rates like that, John, I mean, people are talking about this inversion, this curve, where the long-term rate is lower than the short-term rate.
Yeah.
And they said that's a predictor. I guess that's more like a very easy way of predicting. It's probably not, I don't know how accurate it is, but it's a predictor of a recession.
Yeah.
So what is your thoughts on that? That inverted yield curve, is that what it's called? The inverted
Can I
yield?
avoid this question?
Little blue sky here.
This is one of those areas, that I shudder to make this statement, because it is almost a death knell for an economist.
Sure.
This time it's different.
Is it really? I mean, just thinking about it, a 10-year yield is lower than a 1-year yield. It seems like the most pessimistic view someone could have.
Well, I mean here you got the Fed that had been pushing up the rates, and the rate now is 225 to 250 for the federal funds rate, and but you get the government bond, the 10-year bond, dropping from 325 to 250, under 250. What has caused that? Now, some of us, maybe a lot of us, break up the nominal bond yield into 2 components. One, what is called the real rate of interest, which is connected with the expected growth rate of the economy, and the other portion being expected inflation. Now, over this time period, from 325 to under 250, the expected inflation built into the government bond yield has not changed, or has even risen modestly. So what has happened is that built into the government bond market is an expectation for slowing growth in the United States. Okay, now,
So it is telling a story of pessimism. Yeah.
So the bond market has been showing a picture of pessimism. Now, we get the last week, the GDP for the first quarter of this year was released. Year over year, the GDP grew by 3.2%. You want to hear an amazing fact? For the last 12 quarters in the United States, the rate of growth of the economy has increased.
It's amazing.
Two of those quarters, they stayed the same for the next quarter, but for 12 quarters, that's 3 years, the growth rate in the economy has done nothing but accelerate.
So we predicting that it's going to decelerate? Is that what the market is saying?
Well, that's where the little misconnect seems to be coming in here. And so the question is asked, what's really going on? Well, here you get then a spillover in someplace else. This
So
has
before we have to wrap up in a minute, what should we be looking to expect to see then, or be looking forward to note in the next let's say 6 to 9 months in terms of what's really going to happen? Any comments there?
Well, to me, one of the crucial issues here has been the Fed. And as we talked about, the Fed for the last 10 years, my argument is that they've always wanted to err on the side of monetary ease. I think, again, you're seeing that, and that's very positive to the stock market. The stock market has risen for the last 10 years and hit highs.
Yep.
You note that every time they get a little concerned about the Fed might be tightening or something, the stock market backs off.
Sure.
When they come in, the stock market comes back in. The other thing on that is, and this has just come out in the last couple weeks, tech stocks have, the attention given to Microsoft and
Google,
Amazon
Alphabet.
and Apple and these, Facebook and the like, has just been tremendous. The stock market has gone up, the S&P 500 had gone up 15% at the end of last week. The tech area had gone up 27%. And so that was another driver that's here. And we're seeing that the tech market is bringing a whole new dynamic to the stock market. The third thing, if I can quickly come in on this,
Another 45
you got the
seconds.
Fed, you got the tech stocks, but then the economic growth came in. And that, when you go back to last Thursday, when the new high was hit, and then a new high on Friday and on Monday, they all came after the report came out on the economy.
Wow. So lots of data to watch. That's what I'm hearing. So.
Yeah, but look at the Fed.
Okay.
The market will be, I think, psychologically in good shape if they feel the Fed is going to continue to err on the side of monetary ease.
John, thank you very much.
Paul, thank you very much.
A little technical for me, but
I'm sorry.
I think I get the gist.
Well, it's a very complex time.
is.
Things are changing. They really are.
Thank you very much, John, for
You're
your time,
welcome,
your
Paul.
expertise. You can tell you truly are an economist with a PhD.
Whoa. I don't know whether that's a compliment.
So
or
our
not.
next guest will be Marion Mass, MD, and they're with Practicing Physicians Organization. So watch our show then. In the meantime, remember that on this show, your money matters.